Hello and welcome back to Global Value. In today's video, we're going to be performing a fundamental stock analysis of Stryker Corporation, ticker symbol SYK. We're looking at Stryker today because their stock price recently hit a 52-week low. Stryker has a historical reputation of being a great business. They were actually included in the book Great by Choice by Jim Collins, the author of other books such as Built to Last and Good to Great. Stryker has had a period in their history of being a publicly listed business where they've delivered outsized returns. However, that book came out a number of years ago, so just because they had that historical reputation at one point doesn't necessarily mean that they still have it today. That's what we're going to be looking at. Stryker is also the fourth largest position in the Fundsmith portfolio managed by Terry Smith, known as the Warren Buffett of Great Britain. Terry Smith's investment process is that he only buys great businesses that earn superior returns on capital. He tries to pay fair value or below for the business, and then he likes to sit on his ass and do nothing. The only way that strategy works is by buying great businesses at fair values, and now that Stryker's stock price has come down all the way to a 52-week low, let's find out if the company is trading near its fair value. So currently, the stock price of Stryker is just under $195 per share. Year to date, the business's stock is down 27%. Over the past year, they're down 26%. Since the pandemic and with this recent decline, their stock price has fallen by 2% compounded annually. However, over the past 10 years, the business has returned 14% compounded annually. And going back to prior to the global financial crisis in 2008 and 2009, Stryker has returned about 8% compounded annually. Keep in mind also that this 8.5% compounded annual return is not including the dividends that the company has paid out along the way. So Stryker is $5 over their 52-week low, which is down $90 from their 52-week high. Stryker is a large business. They have a nearly $73 billion market cap. As for some background about the business, Stryker designs, manufactures, and markets an array of medical equipment, instruments, consumable supplies, and implantable devices. The product portfolio includes hip and knee replacements, endoscopy systems, operating room equipment, umbilical coils, hospital beds and gurneys, and spinal devices. Stryker remains as one of the three largest competitors in reconstructive orthopedic implants and holds the leadership position in operating room equipment. Nearly 1/4 of Stryker's total revenue currently comes from outside of the United States. The company sells its products to hospitals, doctors, and other healthcare facilities throughout company-owned subsidiaries and branches, as well as third-party dealers and distributors in approximately 75 countries worldwide. Stryker Corporation was founded in 1941 and is headquartered in Kalamazoo, Michigan. For our fundamental analysis today, we're going to be performing a modified version of the 8-pillar analysis, originally popularized by Everything Money, taking a look at 8 key financial metrics of the business to come to a holistic and beginning understanding of the business based on those fundamentals. So let's get right into it. Starting off with pillar number 1, we want their average 5-year PE to be below 22.5. Currently, Stryker is trading at 37 times earnings, and over this time frame, although their earnings have bounced around a lot, they've averaged out trading at about 44 times earnings. So that is going to be an X to start off on pillar number 1. Pillar number 2, we want their average 5-year return on capital to be above 9%. Over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and these business returns are going to be captured by return on capital. So Stryker has earned above average returns on capital in all 5 years. They saw a dip to their return on capital in 2020, with it rebounding somewhat in 2021. That makes sense with a lot of these implant surgeries being delayed because of COVID. Over this period, Stryker has earned about 13% return on capital in an average year. So that is our first check on pillar number 2. Pillar number 3, we're looking for 5-year revenue growth. Stryker has grown revenues from $12.5 billion in 2017 up to more than $17 billion in 2021. That's a check on pillar number 3. Pillar number 4, we're looking for 5-year net income growth. Stryker's net income has almost doubled over this time frame, from $1 billion in 2017 up to about $2 billion in 2021. It has fluctuated somewhat between then, but again, it's nearly doubled. So that's another check on pillar number 4. Pillar number 5, we're looking for decreasing shares outstanding. When you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. When a business decreases the amount of shares that they have outstanding by buying back stock, they're increasing your ownership percentage in the business, ultimately increasing the percentage of the business's profits that you're going to be entitled to without you having to spend a dime. We want businesses that are either keeping their shares flat or buying back shares when the business is trading for reasonable valuations. Over this time frame, Stryker has very slightly diluted shareholders. They've issued about 2 million more shares outstanding. So that is dilution, so that's going to be an X on pillar number 5. While that's not a lot of dilution here, and this is not something that I'm necessarily concerned about, we'd ideally want this to be going in the other direction. So far through 5 pillars, we have 3 checks and 2 X's. Let's keep going. Pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is cash from operations minus capital expenditures. It's this column here in green. Free cash flow is the lifeblood of any business and can be used to pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back into the business. A business's ability to produce free cash flows from now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately how that business is going to be valued. Looking at Stryker's free cash flow profile, Stryker has significantly increased their free cash flows over this time frame from $961 million in 2017 to nearly $2.7 billion in 2021. That is going to be a check here on pillar number 6. They've also increased their cash from operations and slightly decreased their capital expenditures over this time frame. In an average year, Stryker is producing about $2 billion of free cash flow. So we'll be using that number in pillar 7 and 8 coming up. Pillar number 7, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below their average 5-year free cash flow multiplied by 5. This pillar is going to help us evaluate how the business utilizes leverage. So as of the end of last year, Stryker had just under $10 billion in net debt. So after subtracting all their cash, these would be the debts that they're left over with. And when we multiply their average 5-year free cash flow of $2 billion times 5, that brings us to $10 billion. So just slightly over the amount of net debt they have. That's going to be a check on pillar number 7. Stryker is currently using about the maximum amount of debt that we'd want them to be using and that we'd be comfortable with to invest into the business. So in 2020, they did add a lot of debt. They added about $4 billion year over year from 2019 to 2020. But since then, they have cut that by about $1.6 billion. So they've repaid about $1.6 billion of debt over the past 2 years. As long as their cash flows are able to stay stable or increase, and as long as their debt stays stable and decreases, Stryker does employ a moderate amount of leverage in their business, but they're not overly levered. Again, that's a check on pillar number 7. So far, through 7 pillars, we have 5 checks. Finally, the big pillar of them all, pillar number 8, we want Stryker's market cap to be below their average 5-year free cash flow multiplied by 20. So Stryker currently has a market cap of about $73 billion. When we multiply their average 5-year free cash flow of $2 billion a year times 20, that only brings us to $40 billion. So that is going to be an X there. We're off by nearly $32 billion. Keep in mind that just because pillar number 8 is an X doesn't mean that you're automatically going to throw this business out. Multiplying their free cash flows by 20 is just a starting point as to a reasonable valuation for the business. Ultimately, you're going to want to learn more about the business and determine what's a reasonable free cash flow multiple for the business to be valued at. Finally, here we're looking at Stryker's dividend profile. Stryker has a reputation as a dividend growth stock, and while that's an interesting way to think about businesses, people make mistakes all the time by blindly chasing dividend yield or blindly chasing the hopes of future dividends. So it's really important that you take a look at a business's dividend profile and understand if their dividend is healthy and if it's sustainable and supported by their free cash flows. So in Stryker's case, they've grown their free cash flows over this time frame, and they've increased their dividends in all 5 years. So it looks like their reputation holds up. Based on their free cash flows in the last couple of years, they've had more than enough to be able to pay out this dividend and likely be able to keep increasing it both now and into the future, although this is never a guarantee. But overall, their dividend looks like it's in pretty good shape. So in summary, Stryker checks the box on 5 out of 8 pillars. Based on our valuation multiples, the business currently looks expensive, but in investing, it really pays off to be patient. Over the long run, most businesses are going to trade for just very silly valuations one way or the other. As a value investor, you're ultimately going to do your best when you're able to wait for a great business that is significantly undervalued. Based on our analysis, that doesn't seem to be the case here. However, this type of analysis is just a beginning and holistic understanding of the business. It's not investment advice, and it's not a buy or a sell recommendation of Stryker. Ultimately, as an investor, it's up to you to learn more about the business and truly become an expert on the business, to understand it inside and out as if you owned 100% of the company. It's helpful to learn more about a business by diving into their 10K and reading through their annual reports to get a better sense of the business, its culture, how they're structuring incentives, and how they're thinking about capital allocation. So other than that slight dilution and the relatively expensive valuation, Stryker does produce above average returns on capital. They've seen growth in revenues, net incomes, and cash flows, and the business employs moderate amounts of leverage. So it does look like it has overall strong business fundamentals. Again, it would appear that it's slightly expensive right now. Stryker also has a dividend profile that looks very healthy, and it looks like it's in good shape. So with that said, that's it for today's fundamental stock analysis of Stryker Corporation, ticker symbol SYK. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Stryker with me, and have a great day.